All right, we'll get going. Yeah, I think you can, not sure what it looks like on your end, but anybody that has a question, like as I talk, if you want to say anything or go on off mute, let me know here in the chat or Q&A here. So we got 11 people so far. It's our first webinar. So I'll walk you through real quick. I was going to go to, kind of a quick walkthrough of some concepts and then go right to Q&A, and we're recording this so we can always shoot this out to you as well. But so basically, wanted to discuss metrics and kind of which metrics to focus on for which type of investment or purpose, whether you're broker doing a BOV or an OM or your investor. I took a value add investment as the example in this case because to cover everything would just kind of be overwhelming. So I chose multifamily value add as kind of like an example to then discuss kind of how I would think through which metrics to focus on. And then, we can always, if you have any questions offline, we could, I can give you other examples for commercial deals or different types of investment profiles. But in this case, value add investment, they typically fall, have some share or some common characteristics. They have some in-place cash flow, significant capital needs to get markets from as is to market or to lease up vacancy, whether it's commercial or multifamily. Highly dependent on the cost of capital. So debt and equity, debt's obviously gotten more expensive, and equity is expensive. So when you're putting all of that capital in year 1, year 2, year 3, there's a quick, there's a burn on that cost of capital. So that when you're looking at IRR, for example, the quicker, shorter hold period is better. But again, so just something to keep in mind when you're doing a value add. It's like that cost of capital. The earlier you incur it, the quicker you kind of want to exit. In terms of the modeling and the IRRs, return metrics. Really, when you're thinking about which return metrics to focus on, like I said, timing is key. Also, total profit. So like equity multiple is a big one. And then kind of stabilized income would be maybe if I'm going to hold it for a longer term and more of a passive investment, what's that cash on cash type of return? And then, typically value add investing highly dependent on the residual pricing, which is really, it's hard to predict. Obviously, there's a big market cycle risk, timing risk, and I would say not just pricing but timing. So the big risk in any value add investment is going to be what's that residual sale, and then how dependent are the returns on that sale. So I'll get into that a little bit. So here's kind of a breakout of the kind of the key metrics that I would look at. Levered IRR is an obvious one. It captures the profit and timing. The problem with IRR is it's really variable. So like it might work on paper as a, let's say 15 levered IRR or 20 levered IRR, but one thing goes wrong in your underwrite, whether it's timing or cost, and your IRR drops quickly. Let's say it was a 20, now it's a 15, now it's a 10, and you're out. Your investors are, you might be out of the promote structure, and it's really easy to drop out of that target IRR. So return on cost is another one. The great thing about return on cost, it's simple. It's the NOI divided by all in cost on the investment. So it's a real simple, easy to understand, easy to communicate to investors and anybody involved what that is. The challenge is that it only works if your residual cap rate, your exit cap rate's going to be lower than your return on cost. And again, that's a huge market risk. It also ignores timing. It could look great, but not be great IRR. So it's just one one thing to look at. Equity multiple, again, simple. It's great in terms of your equity, your LP equity, your equity partners. It's, if you communicate like a 2x or something attractive to them, again, it's simple. It's easy to communicate. It's easy to understand. And again, the weakness could be, how long does it take? It might take a while to get there. Stabilized cash and cash. Again, it's cash in pocket. It's easy to understand. And if you're looking at longer term holds, in terms of like buying something, improving it, holding it, it's a really good metric to use. The problem is, as we've seen with debt markets, it might work on a cash on cash basis, but then if you have to go refi, or if you have variable interest rate, all of a sudden your cash on cash doesn't work. So it's just one more thing to look at. And one thing to note is that I'll look at all these things. I'll look at the going in cap rate last, because it really shouldn't drive the value, but it's also something that you look at. So it's kind of like it more like falls out of the model than drives it. So I pulled in a really simple analysis for like a value add multifamily, dropped in the spreadsheet here. I can share the spreadsheet with you if you want, just let me know. But current rents, market rents, just some few assumptions on capital. You renovate it over 3 years, you exit in 3 years. So unlevered IRR 14 in this example. If something happens in year 3, if it takes you longer to lease up, or the capital markets aren't good in year 3 and you have to kind of push that exit, the IRR drops from 14 to 11, and there'd be more variability if we were calculating the levered IRR. But this is just kind of a good example to look at, the going in cap rate, 5.8, return on costs, 7.5. So you'd have to be confident that your residual cap rate is, going to be significantly below that, or it's 7.5, and then equity multiples 1.5. One thing, when deals gets pushed out, your IRR goes down, but your equity multiple goes up, which is good. One calculation, I didn't show it here, but one thing you can do when you're doing the IRR, but when you're doing the unlevered IRRs, you can take this 11%, use it as a discount rate, and apply it to the residual sale, and then apply it to the cash flows. So you see what percentage of that IRR, of that 11%, are from cash flows versus your residual sale. It shows you the risk in achieving that IRR. And last thing I want to show is just this could be it's pretty simple here in terms of, it could be kind of fancied up in a presentation in terms of like graphically, but this is kind of the idea of showing whether your broker showing an investor, or if your investor showing equity capital, kind of showing each metric, and then at different values, and do they work in terms of, are they attractive in the current market? So it's really good page if you're a broker to show your client investor, like with a BOV. We looked at all of these return metrics, and they work at these prices. Yellow being kind of like on the bubble, red, which I'm not showing here, would be kind of, it doesn't work. And it's always kind of a mix, and it's always unique, and there's no kind of cut and dry answer, but it's just a good graphic, and there's probably a chart you could show that's a little bit more attractive. But yeah, so that's it. That's all I got. So open it up to anybody have any questions. So I think you can just put something in the Q&A or the chat, and we can go from there, but just let me know. I know it's pretty quick, and I can share the Excel examples if you want. All right, so Landon, can you explain the difference between return on cost and cash on cash? So return on cost would be, yeah, I could shoot it to you, but so return on cost here, right here is 7.5. Well, let me share. Hold on. Sorry about that. So you got return on cost, 7.5. So the way you calculate that is your NOI of 2.4 million here divided by the denominator is going to be your purchase price and your capex. So, and I can send you an example of that, but it's basically 2.4 million divided by 30 million plus 750 plus that, and it's just that ratio of so cash on cash. I don't have debt in this model, but cash on cash would be your net cash flow minus your debt service. So your payments, debt payments for that year nets out to so after debt cash flow divided by your equity investment. So that'd be the cash on cash, and I could shoot that over to you too. And Vito, how often are people using CAGR as a metric? Yeah, I look at that as well. And I'm trying to remember, I forget what it stands for, but CAGR. Anyway, can you spell out, Vito, what that is? Compounded annual growth rate, yeah, of the value, right? So you buy it for 10 million, and then you sell it for 15 million in 5 years. What's that compounded rate of appreciation? Yeah, something I look at. It's not typically to me a huge driver, but it tells you something about the model. Like if typically if you're buying something, putting a ton of capital in it in a strong market and you exit, it does show you kind of the risk factor as well. Because if you're counting on a high residual sale to drive your returns, that's going to be reflected in the CAGR. All right, anybody else? Well, yeah, if there's nothing else, I'll wrap it up, and we'll ship this out to you. Oh, we got one. What are you seeing in terms of goal IRRs for investors across different asset classes? I'll say, like, I look at a lot of office deals, and those are at least value add is going to be mid to high teens levered IRRs, and then anything like development, it's going to be 20 in the 20 plus. I can't speak as well. I don't see as many like multifamily, and it changes in the market cycle and the field. Oh, certainly free to open that up to anybody that wants to speak to that. But I know with office, it's goal IRRs. I always think of development deals at least in the 20s, but and then value add is mid to high teens typically levered, and then anything that's like kind of core plus, maybe with some light value add or some mark to market strategy or something kind of light capital, what to me is like low teens IRRs. And then also one thing that you might want to think about is kind of always underwriting a longer hold period than maybe you could execute, so you could outperform those IRRs. Like instead of underwriting a 3-year hold, underwrite a 4 or 5-year hold, just because of the risk in that timing. All right, anything else? Yeah, thank you, everybody. And I'll send this out afterwards. Let me know if you have any questions or would like the source files or any calculations that I showed here, and we'll talk more. Thanks.